Hi, I'm Jenny Brown. A very, very warm welcome to this week's MFB News. I hope you've had a lovely week. Everything's been good with you. It's still raining. What can I say? It just seems to never end. I think actually maybe we should go into mortgages for ARCs next at this rate. Anyway, I'm not going to moan about the weather, which is my favourite pastime, incidentally. But what I am going to do is tell you what we've got for you this week. So we're going to do our usual roundup on what's been happening with lenders. There's not much to tell you. It's been a very quiet week, and we'll also talk about why that is also. Obviously going to cover off what's happening with swap rates and how that's impacting pricing. We're then going to have a look about the latest news in terms of house prices and what's going on in the housing market. And then finally, I'm going to give you an update on what's happening with me getting back my buy-to-let property. And there is an update. I mean, it's a very underwhelming update, but there is an update nonetheless. I'm going to share that with you also. Okay, so last time we spoke, we were just in advance of the base rate meeting. So we know that base rate went up by a further 25 basis points. In terms of how that impacts things, so look, I think that's really, to my mind, it's kind of like the MPC sitting on the fence. So some people were saying there was going to be no base rate increase. Some people were expecting a half for various reasons, in terms of largely in the newly released ONS data in terms of inflation figures that came out at the start of last week. Or actually on Wednesday, sorry, because I had to re-record the video, didn't I? So I think the Bank of England were faced with a very, very challenging decision. So what they did is kind of take a soft measure rather than a hard stance in terms of the 0.5%. Is that the end of it? I think only time's going to tell. We're just going to have to watch very closely inflation figures and other data in terms of what's going on with consumer spending, because actually on the high street that performed really quite well last month, and also in terms of people's pay as well. So people keep getting pay rises, people keep being able to spend money, and that's going to just drive inflation up. So we're in a bit of a almost like a spiral at the moment. So I've never not wished for a pay rise, but actually this is one of those times where I can see how actually in the broader scheme of things it can be detrimental for some people. Okay, now in terms of what this has meant for swap rates, so the money markets, where we know that interest rates had floated up with the news of inflation and interest rate increases in the Eurozone and the USA. Then what happened was the Bank of England went up by 0.25%, and so swap rates, so the money markets reacted really well to this. And on the day, and actually the next day, swap rates came back down, and they were hovering at just over 3.5%, which was obviously really encouraging. The money markets obviously really liked what the MPC had done. In subsequent days, we've seen things move up slightly. So as of 10:30 last night, which is the most up-to-date data that I have on swaps, 5 years were sitting at 3.671. So actually go back 1 month ago and 5-year swap rates were at 4.013. So we are in a better place than we were then. Interestingly, if you compare it to 1 year ago, swap rates were at 1.857, but we're not going to think about that because those days are sadly gone for now, at least. So in terms of how this has kind of filtered through to the mortgage market, so fixed rate pricing has come down a little bit. Have we seen a flurry of lenders reducing their fixed rates? No. Why is that? Well, we talked a bit about this last week. So swap rates were previously at sort of 3.5, 3.6. Then they floated up to around 4 with the news of the inflation overseas. And at that point, despite the fact the cost of funds going up on the money markets, not all lenders, in fact, very few lenders pushed up their interest rates. A lot of them, I think, were kind of just, there's been a lot of rate changes, a huge amount of rate changes. And I think the lenders were thinking, we're in a position where we can afford to kind of just sit on this for the time being and see how things shake out. So let's just wait and see. So a lot of lenders didn't actually put up their pricing. So now pricing has come back down to 3.5, 3.6. And we're kind of back to the territory about where it should be in terms of the rates that were available on the market anyway. That plus the fact that swap rates are bouncing around by circa 0.2% on an almost daily basis, I think it's actually really, really hard for lenders to know where to price things at the moment. So I think what we've seen in the last week is everyone just basically sitting back and watching the market and really trying to figure out what their next move's going to be. We are expecting that you will see some lenders start to shave very small percentages off their interest rates. And by that, I'm literally talking 0.1%, 0.15, like not big jumps. And that's going to be more to do with the desire to drive in new business rather than the cost of funds coming down. So the lender's saying, well, okay, we're going to take a bit of a haircut on our margins, our profits, to try and generate new business and get people in through the door. Now, having said that, we have seen a couple of changes in the last week, but like I say, I mean, compared to previous weeks where we've had absolutely loads, it has been very, very small. So we've seen Clydesdale reduce their pricing. Their 5-year fixed rates are now from 4.6, 2 years from 4.82. Incidentally, 2-year swaps are still sitting at a higher level than 5 years. So 2-year swaps are at 4.128 compared to our 5-year at 3.671. So 0.5% more expensive. So that's why your 2-year money is, generally speaking, still higher than your 5 years. So yeah, so Clydesdale, so 4.65 years from 4.82 for 2-year money. Clydesdale as a lender, what do we think of them? So very, very vanilla. So no limited companies, no HMOs and multi-units. They do not like people with large exposure to the property market. So what the Clydesdale do, which is kind of wonderful for a contingent of people, and an absolute nightmare for everybody else, is they will do an overall affordability calculator. So they're going to take a mortgage applicant's overall income and then look at the overall indebtedness, and that includes all your buy-to-let mortgages, and they run like an affordability calculator. I think they can go up to around 8 times income. So as long as your overall kind of debt in terms of your own mortgage, all your buy-to-let mortgages and your personal HP and credit cards and that kind of stuff is no more than around 8 times your income, then Clydesdale can lend to you. Anything other than this and it stops working. So where this really fits well is for those people who have probably 1 or 2 buy-to-lets and a good sort of income, basically. Now, Clydesdale are great because they can look at not just salaried income, where they're very, very strong is self-employed people, so contractors, and also people who have limited companies. They work on retain net profits in the business rather than how much you've actually taken out salary and dividends. So that's really, really good. So actually what you do get from Clydesdale is some really keen pricing. And the other thing is, because they're doing an overall income stress calculation, their rental calculation is really generous. So there is a real place for them in the market. But like I say, it actually works for very, very few people. But for those people who it does work for, and we've actually placed, over the years, many mortgages on this basis, it's actually been a really great thing. Now, we've also seen Foundation Home Loans make lots of changes to their products, but the key message for you guys is their 2-year pricing is now from 5.94 and 5 years from 5.99. And these products actually have flat arrangement fees. Now, Foundation Home Loans, they're a specialist lender. We all know what that means, don't we? Limited companies, HMOs, multi-units, large portfolios, no minimum income, it goes on and on. But actually, they're a very, very good lender, and they do have some real niches in their policy. So one of the things that we really like about Foundation Home Loans is when they're lending to a limited company, they're taking a personal guarantee and therefore underwriting only the directors, which means that they can accommodate for layered companies. They can accommodate for companies where you've got maybe sort of a real family where you have many shareholders. They don't mind that. It's all about the directors. So that's really good. So they brought their pricing down. Is it market leading? No, but actually they have a really solid set of criteria sitting behind that. So, it's still really great to see their pricing come off the boil. Now, similarly, CHL have made some changes to their products, and they've made some interesting things. So they've actually been removing some of their products. So they had a really big product set, actually. So you have very, very low rates with very, very high fees, and then it kind of works its way up. So you get to the point where you've got higher interest rates with nominal or no fees whatsoever, and also some flat fee products. So what they've done is remove a couple of the products where there are flat fees and some of the higher percentage charge fees as well. And they've also removed some of their tracker rate products. They've increased rates on their short-term lets, but the rest of their product set has stayed the same. What's going on here? I suspect what they have done is just been looking at the type of business they're lending on, realising that certain product lines are actually not commercially working out so well for them, so just plucked them and taken them out of their product set for the time being. Similarly, on short-term lets, it could be that their pricing was such that they're getting too much business on that level. So no lender wants to be exposed to one segment of the market. It's too risky. So if CHL were finding that they were getting lots and lots of applications through in short-term lets, but very little else, they're going to pull the plug on that because they are going to have too much exposure to that part of the market. So maybe that's what's been happening there. Incidentally, lenders don't really phone us up and say, oh, we're putting our products and this is why they just remove the products. It's only sometimes we can have slightly informed conversations to really dig into it. So we can only really surmise rather than know for sure. But what's left over from CHL is not bad. They have rates from 5.37, watch the arrangement fees. But CHL are a really, really solid lender. We really enjoy working with them. And they do all the kind of things that you would expect a specialist lender to do. And lastly, from the lenders, we've seen Fleet remove their tracker rates from the market. Now, that's quite an interesting one because arguably tracker rates are not as kind of at the mercy of cost of funds on the money market because it's just following a current rate of interest. So I suspect that Fleet have probably found that because the trackers are now so high, whereas, you know, rewind 5 months ago, lots of people were asking us about trackers, that conversation's largely going away again now. So I suspect maybe they're just finding that actually just isn't much appetite for them. And it costs lenders money and resource to have products available in their product set if they're simply not shifting any of them. So they've probably just taken a decision to pull away from that. So that's really all the changes from the lenders this week. What we have seen then is is it an easing on interest rates? Let's have a look. So in the personal space, 2-year fixed rates are from 3.99. I feel like I've been giving you the 3.99 number for a long time now, so that hasn't really moved. 5 years are from 4.25. Now that does feel like that's come down actually. In the limited company space, your 2-year fixed rates are from 4.51% and your 5-year fixes 4.29 if you don't mind paying a 7% fee. If you don't want to pay a 7% fee, then realistically you're looking at 5-year rates from around 4.9%. Interestingly, just to give you a kind of overview on rental calculations, because this is also really important for people and it is causing some real challenges at the moment. So in the personal space, broadly speaking, on 5-year fixes, you're looking at 145% coverage or possibly 125 depending on whether what your tax coding is and also whether you're doing a like-for-like remortgage or not. So 125 or 145 on an interest rate of circa 5.25. In the limited company space, we can get, if you're willing to pay those really high arrangement fees to get the very low interest rates, you can get rental calculations of 125 at 4.29. But actually, more broadly speaking, you're looking at about 125 at 5.5%. Okay, now there's been some data that's been released from the ONS with regards to house prices. I'm going to need to read this to you because it's quite data heavy and my mind at 7 o'clock in the morning just isn't that absorbent. But it's quite interesting actually in terms of giving you a flavour of what's happening. And the ONS obviously we quite like because it is just a very, very impartial, no vested interest set of data, rather than some could say that, you know, just, I mean, Halifax house price index would be a prime example of this. It's wonderful, it's really, really helpful. Halifax are a mortgage lender, so they're not totally separated from the market, whereas the ONS are completely impartial. And that's not me, by the way, saying the Halifax are kind of manipulating the data or anything like that, but just for me it just feels slightly detached from things and therefore, you know, very, very something that can be relied on essentially. So despite a slowdown, average house prices rose 6.3% in the 12 months to January this year to reach £290,000 across the UK, despite buyer affordability issues. The average house price rose £17,000 to hit £310,000 in England, £217,000 in Wales, £185,000 in Scotland and £175,000 in Northern Ireland. And this is according to the January Office for National Statistics House Price Index, by the way. Price inflation in Scotland plummeted to 1% at the start of the year, down from almost 14% in April 2022. Now, the ONS explained that price volatility from 2021 to 2022, following the changes to the stamp duty land tax, disrupted pricing and resulted in the eventual slowdown in house price growth from 14.1% at its peak in July 22 to 6.3% at the start of this year. So house price growth has slowed down, but it is still growth. I think that's the really important thing to note here. Excuse me. Now, affordability pressures. So the official figures also confirm the worsening affordability position for full-time workers buying a home in England, having to stretch to find over 8 times income or 6 times income in Wales. The figure shows there is a patchwork of affordability issues, however, with ability to meet prices actually improving in 71% of local authorities, where inflation has stalled, worsening in 89% and staying the same in 2% since 2021. In 2022, full-time employees in England could expect to spend around 8.3 times their annual earnings buying a home. The equivalent figure in Wales is 6.2 times annual earnings. Over the last 25 years, housing affordability has worsened in every local authority, especially in London or the surrounding areas. So there you go. I found that really interesting, and I think it really just serves to demonstrate that the housing crisis, the issues are still very, very prevalent in the market. Interestingly, rents are now equating for, on average, over 30% of people's take-home income as well. So people are feeling incredibly stretched in terms of just affording to live independently. What I would say is that we are reading increasing reports about buyers who are literally saying, you know, either I can't afford to buy a property, and because despite the fact there's been a house price slowdown, it's still a growth. So things have become less attainable, and also because some lenders have changed their affordability calculations. When lenders are looking at homeowner mortgages, what they have to do is take someone's monthly income, deduct all the things that they know that they're going to have to pay, and whatever left over can be apportioned towards paying a mortgage. And then you work it backwards. So, okay, well, if you've got this much left over, that equates to a mortgage debt of this amount of money. So that's the kind of way lenders do their affordability calculations in the homeowner space. And so what we're finding is that because they're looking at sort of expenditures, so how much do you have to spend on council tax? You know, what's the average household spend on food, clothes, you know, after school clubs, all this kind of stuff, travel. Because price costs have just gone up, the data they're using has gone up, and that means that it's eaten into affordability calculations, which is making things less attainable for people when they're looking for homeowner mortgages, basically. So this is really driving more people into the rental sector, which is going to continue to underpin the increasing level of rents, and it is expected to increase for the rest of this year and the next year and the year beyond that, incidentally. And I think that combined with the fact that there are just less rental properties, partly because of some landlords divesting, partly because there's less churn on the market, because tenants are staying in properties longer, because quite simply they can't afford to move to somewhere else, or there is nowhere else to move to. So again, it's kind of spiralling. This is really driving up the rental incomes, which, you know, obviously there's a moral responsibility to tenants, but as landlords with rising mortgage costs, actually this can be regarded as a positive thing. And lastly, the buy-to-let, getting back from non-paying tenant horror that is my life at the moment. So, okay, so sorry to keep recapping on this, but for those people who haven't actually been a part of this journey that I'm burdening you all with, so I have a tenant in one of my properties. They stopped paying their rent last year. We issued a Section 21. The end date passed. They said they were not moving out. They were waiting for housing from the council. So we then approached a lawyer to kind of take things forward to court. The lawyer then advised that actually the date on the Section 21 that the estate agent had filed was incorrect. We had to start all over again. So at that point, we issued a Section 8, which is where rather than me saying, I simply want my property back, that's me saying, you owe me a lot of money, you need to go now. And we also issued a Section 21 at the same time. Now, the Section 8, unfortunately, then stalled. We got a court date through, so which was for, I think it was meant to be for next week, actually. But then the day that we issued, the court issued its hearing date to the tenant went into something called breathing space, which meant that my Section 8 had to be postponed, because under breathing space, this is where someone's in financial difficulty. They have a period of time where you cannot pursue them for any owed money, basically. Fast forward to now. So we were waiting for the breathing space to end so we can go back and apply for a court date for the Section 8. Likewise, the Section 21, the 2-month waiting period had ended, and we were waiting for things to move forward there. So two things have happened, which is very, very exciting. My Section 8 court date has now come through for August, which I couldn't believe. So that means the tenant would have been not paying for a year at that point. Thankfully, we have the Section 21 rumbling on as well. So with the Section 21, so the claim was issued to court on the 14th of March. And I've got the notice here in front of me. And the court have very kindly written back acknowledging that they have received my Section 21. They've issued a notice of issue. But they have not yet served the claim on the defendant, but they are going to let me know when they've done that. So that was the 14th of March. What are we now? We're on the 29th, so 2 weeks later. They still haven't served the claim on the tenant. I'm sure they'll get around to it in their own sweet time. Once they do that, the tenant then has 14 days to file a defence. Now, if they do file a defence, that means that there's going to be a court hearing, and we're going to have to all shuffle over to the courts to have a meeting. God only knows when that's going to be. I mean, if the Section 8's in August, I mean, autumn probably. However, what the hope is that the tenant will not file a defence. So then eventually a judge will pick up the file, go through and see that we've got all our paperwork in order, we've done all the right things, and I really have done all the right things, by the way, and then issue the claim, or agree with the claim, and then tenant will get notice to vacate. And at that point, I suspect then we're going to be calling in the bailiffs, which is a whole nother world of waiting, incidentally. So yeah, look, it's progress. It's progress, but it's really frustrating. Everything just takes so long, and every day, week, month is just costing thousands of pounds. So it's really, really agonising. but I'll keep you posted. So that's the latest anyway. So hopefully next time I'm chatting to you, I'll at least have some kind of progress on the Section 21. They might have got around to at least telling the tenant that it's all going through, but I won't hold my breath. And they have time, because actually I'm not going to be here next week because I'm having a week off with my family. So I'm going to see you in 2 weeks' time, but that means the court has got an extra run in to get themselves sorted and get my claim moving. Will they do it? Let's wait and see. And that's everything for me this week. Sorry if this video is just turning out to be a massive whinge fest. I do debate whether I should be telling you about this, getting my property back, because it's really hard to do it in a kind of positive and cheerful fashion because it is so annoying. But I do actually know that quite a few people have messaged saying it's actually really interesting to hear. Thankfully, most of you don't seem to have gone through this experience, which is a great thing. So I guess it's quite an interesting learning thing. So I'm going to continue to share, but I am sorry if it comes across that I'm just moaning at you. So like I said, this is us for this week. I'm not here next week. I'll be back the following week. So I'll see you just after Easter. Have an amazing time. I hope you all have a lovely, lovely long weekend. Let the weather be kind. And if you have any questions, we're working, you know, all over Easter, obviously not the long weekend, but either side of it. So do give us a call, 0345 345 6788. Look after yourselves, keep warm and dry, and I'll see you next time.